We start. Hello, dear members. Today we have another TÜYİD webinar on creditor relations in tough times, and we have two valuable speakers. One is Mr. Patrick Tobias from IHS Markit Director, and the other one, Mr. Markus Walshofer from DebtBay, Managing Director. It's my pleasure to introduce them. Please, Patrick, floor is yours.
Thank you very much, and welcome everybody. A lot of you might know me from more the equity side of things, and today I would like to talk to you about creditor relations. And Dr. Markus Walshofer has joined me as an outspoken expert in the industry. He is well known for a number of publications and articles in the local press here in Europe. And important to mention that he used to be an fixed income portfolio manager and has worked for a large German blue cap as a responsible for issuing debt. So with that, I would like to quickly come to our agenda. We have 3 points on the agenda. One, why creditor relations make such a difference, especially in these markets and with Corona coming. The second is talk a bit about the secondary market and the relevance of the secondary market and how it can influence the next bond being issued. And the third, very important, is to know who your investors are, who are the people that buy your bonds. And the fixed income market, as you all know, is extremely intransparent, and we will show you what matters and where to find the relevant information. Here, I want to give you a quick overview of the credit spread over the last basically 3 years, and it shows very clearly that the cost of refinancing, because that's what this is all about, has increased remarkably. And 2% on a bond is a huge amount of money, which we will talk about a little bit later. And this shows very clearly that the different indices from iBox for corporates, non-financials with different ratings have gone up remarkably, and this is what this session will be all about. With this, I would like to hand over to Markus. He will now speak about why creditor relations matters and why it's important to speak with bond investors. Markus, over to you.
Thank you, Toby, and a warm welcome from my side. And thanks a lot to Bülent for inviting me to this webinar today. I have the pleasure to present you 2 key elements today. First, I will talk about the importance of creditor relations and, of course, of its benefits to you. And second, we will talk about why secondary and primary markets have a close link together and how you as a company can take advantage from secondary market coverage. So as a starting point, let's start with a short summary. What the creditor relation concept is all about. It is a strategic, continuous, and interactive relationship management to your lenders, of course, your current lenders as well as your potential lenders. And the second big group are the intermediaries on the international debt capital markets, represented by rating agencies, fixed income analysts, and the financial market press. On the right-hand side, you can see a graphic showing the 2 main forces of debt. At first, on the left side, it is the banking sector, the traditional banking sector, and on the right-hand side, they are the international debt capital markets. And over the last 15 to 20 years, there has been a strong loan to bond trend because that international debt capital markets have gained massive importance, while the banking sector has shrinked since the outbreak of the financial crisis. And the reason for this astonishing development can be found foremost in four aspects. The first aspect is the increasing regulation within the banking sector, which has, of course, negative effects to lending from the banking side, and which also makes funding by banks much more expensive than it has been in the past. Second, it is the increasing demand for corporate bonds from the asset management side, because sovereign bonds most of the time are too risky. For example, if you think about Greece or Italy, or they are in the negative area like Germany, where as a buyer of debt, you have to pay for buying debt. And this is really a crazy market environment we are facing now since about 2 to 3 years. And this explains why there is a strong demand for corporate bonds. The third reason is the increased financial freedom an issuer can get if he gets funding from the financial markets, because the monitoring is not so close than it is by the banks. And the fourth and almost most important aspects for the loan-to-bond trend is the reason that debt capital markets have an international character, which you can see on the next page, providing a huge platform to companies. And of course, the more lenders you can attract outside of your home market, the lower the interest can be you have to be for your debt, just because, and this correlation is quite simple, because you can attract so many international lenders with huge amounts, with huge assets under management. So let's take a closer look into the main benefits of creditor relations. At first, and this is a really important aspect, it is important all the time, but it is especially important now as we are facing globally, there are tough times ahead of us. It is the ongoing access to debt capital markets as an additional funding source apart from the banking sector. And we all know that debt has to be refinanced continuously, and therefore, and the word ongoing is really key in this context, the ongoing access to different segments and markets of the DCMs are really key for corporate survival, especially in the crisis we all are facing right now. The second aspect is the possibility to reduce interest expenses. I've already alluded to, as the international debt capital markets offer a huge funding platform. This gives you the chance to lower the interest you have to pay for the debt. And this, of course, has a direct impact on earnings. And the third main benefit coming from creditor relations is the possibility that you have another instrument for raising a company's overall profile. And this follows, of course, the same principle of public relations and investor relations, which you are an expert for. And even also important to mention is the fact that creditor relations is a substantial component of corporate and in specific of capital governance, which is chaining on influence, which you can see on the next page. So let me spend a few words on the capital governance concept. It is a segment of corporate governance and therefore of ESG, and it refers to the capital structure of your company. In times of digitalization and artificial intelligence, analysts have a wide range of opportunities to analyze your capital structure in detail. And I really mean in each and every detail from outside. And especially equity especially equity analysts, want to make sure their money, because they are the owner of the company, is spent well, and that you as a company manager only pay the level of interest which is absolutely required. And this shows, and this is a very important message I would like to make here on this page, this shows that the creditor relation concept is also from key importance for your shareholders and therefore your everyday work. So let's come to the second part of my presentation, covering the questions why secondary market coverage is key and how you as a corporate issuer can take benefit out from it. The secondary market is therefore key for pricing new debt instruments on the primary market, because it is the key benchmark for pricing new issues. And I think this really central context I have to explain a bit more in detail, which you can see here on this page. At first, you see some blue dots. Those blue dots are representing outstanding bonds of a specific issuer. You can see the yield, the secondary yield of those bonds outstanding, as well as the time of redemption. And of course, most of the time, it is true for about 95% of all issuers. The longer a bond is living, or the longer the duration of a bond is, the higher the yield demanded by investors, just because of the simple fact that the risk is increasing over time. Once you have those bonds gathered, those dots gathered, it is quite easy. You can derive the really famous secondary market curve, which you see here, the green line. And this is a really important source of information, because it gives an investor and you as an issuer, so both sides on the capital market, a very crucial key information how much interest an issuer has to pay according to the duration he is intending to issue on the market. So let's make a short example. If you are intending to issue a new bond with a duration of 8 years, you can see from your secondary curve that you have to pay a bit more than 4% plus a new issue premium. The new issue premium is important to attract new investors to participate in your new issue. And the second thing I want to highlight your attention to is on the next page, because when we are talking about corporate bonds, it is important to mention that the yield of a bond consists of different elements. At first, there's the so-called basis, which you can see here, a quite small portion in gray, representing the so-called risk-free rate subject to duration of a debt instrument. And for Eurobonds, for example, the risk-free rate is represented by the yield of the German treasury note, the German Bundesanleihe. And since about 2 years, we are facing really crazy times, because the yield of this of almost all German treasury notes are in the negative area for up to 30 years. But for a better understanding, for a better illustration, you can see here on page 13 a small, and it's really imaginary basis, which is in the positive area. The second and most important component is the so-called spread, which reflects the specific risk of a specific issuer. It is the credit risk. And this amount of yield shall compensate an investor for the additional risk when investing in a corporate bond. And since more than 10 years now, the spread is by largest the biggest yield component. So to make a short summary, basis plus credit spread or spread are the secondary market yield. And when it comes to issue a new bond on the primary market, there is a further yield component to mention. It's the new issue premium for attracting enough investors to participate in a bond. On the next slide, and this is really the key slide of my presentation today, you can see the potential of creditor relations. At first, you see the spread, the risk premium area, and this is the sphere of activity of your creditor relation efforts, because they shall have a direct impact on the amount of risk demanded by investors. And as well, it is to a certain extent a success measurement for your creditor relation activities, as professional debt capital market communications are able to lower risk premium demanded by investors really meaningful. And of course, this effect leads to that the blue dots of your curve are going down, because the secondary market spread is shrinking, so is the yield. And once the bonds, the blue dots representing your outstanding debt, also the secondary market curve in green goes down. And this means nothing else that you have a much better prerequisite for starting a new bond issue, because then the benchmark everybody is looking for is at a much lower level, which saves you a lot of interest. How much interest can you save? You see it on the next page. Here I made for you the basis point value. You can hardly see it because it's so small. It's on the right column. It is the very small green part representing 1 basis point. 1 basis point is 1/100%. To be precise, it is 0.01%. So it is almost an amount which you can hardly see, but the influence on your interest expenses you have to pay is enormous, because if you are just able to save 1 basis point, it will reduce your interest expenses by 400,000 euro. 400,000 euro, for example, for a bond with 500 million volume, a so-called benchmark bond, as well as a duration of 8 years. And I think it's needless to say that in practice, the savings potential is much higher. It is really much higher than just 1 single basis point. And this adds up to most of the time to savings of some millions. With that, I would like to make a short summary on page 16, where you can see the ultimate target of creditor relations. It is lowering the secondary yield of your outstanding bond. This will lower the secondary market curve, and this will saves you a lot of basis points when it comes to the next primary market transaction, and will improve your financial and overall earnings quite substantially. And with that, I would like to give it back to Dowie.
Thank you very much, Markus. That was very impressive, and I think the numbers as such speak for themselves. So now let's take a look at a little bit of the background information that is required to make all these conclusions. One thing I would like to point out, which most of you are probably aware of, but just to highlight it again, is the difference between the equity and the fixed income market. So I don't want to go through every single one of them, but I think 2 things are very important. A, it's the nature of the game for equity. Of course, we all know it's traded or mostly traded on the stock exchange, and that means there's a high transparency on the volume, on the price, etc. Whereas on fixed income, it's an over-the-counter interaction between banks, and the transparency is extremely low. You don't know a price, you don't know who are the market participants, and a lot happens discreetly on a bilateral basis. And the second big difference between equity and fixed income is the risk orientation. So equity people, they are prepared to take a certain investment risk because they directly participate from the upside potential. Whereas fixed income, once you have agreed on a certain interest rate, the train has left the station. So fixed income investors by all means want to avoid risk. They want to have transparency. They want to clearly know the risk. And that, of course, goes back to creditor relations and what creditor relations can do. A second thing I would like to point out that is very commonly, I think, mistaken, what I've heard from a lot of issuers, is that the bonds are buy and hold. That is not true. Bonds are traded. They are traded over the counter. So as I said, there's a bilateral trading. It's an interbanking market, and it's very difficult to see what's going on. It's highly decentralized, and the volume and prices are not publicly disclosed. So there's virtually no way to just look at a website and see what's going on. But the matter of the fact is that the volume of a bond is frequently traded. What we can see is about 70 to 80% of the volume is traded, which means a normal bond, corporate issuer bond, is traded 2 to 3 times per year. And why is that the case? Well, because there are active and passive investors, as you know, and the active investors, they are eager to outperform the market. They are eager to beat the index. And this is what they are doing. They're trading equity. Of course, we all know that, but they're also trading bonds. So if they see an opportunity to be better than the index, they will trade a bond, be it buying or selling activity. And the second group we all know about are the passive investors, typically ETFs. And they have to trade because they have to stay liquid. So if they have capital inflows or outflows, they have to take care of that by trading in the bonds or equity, whatever it might be, that they are invested in and represents a certain index. So a lot of trading happens. And now to get some more transparency around this, that's one of the key markets that IHS Markit is involved in. We have agreements with the major players in the market, and it's down to the basis of if you give us data, we give you data. And the banks have a big interest in knowing what's going on volume-wise and price-wise. And they have agreed to provide us with data, with volume. And in the iBox family, and the idea is iBox indices, you can see an aggregation of the bond market. So it will provide some liquidity. So you know how liquid a bond is, and you know what the price for the bond is. And what that looks like is this curve here. It gives you a good overview on the price. And if you take a look at this blue line, it's a Deutsche Telekom, so a very solid frequent issuer. But the difference between the highest and the lowest point on the curve is almost 10%. And even if you leave COVID out of the equation, there is a difference of 4%. And 4%, as Markus pointed out earlier, for a benchmark bond is an enormous amount of money. And it is very relevant to see that curve in the secondary market to understand what a new bond would be priced at. And the second one is the liquidity score. And that's where I supported this with this little blue arrow. We are tracking liquidity of the bonds, and out of the 14 bonds that Deutsche Telekom has out there, you can see 10 of them are very liquid. So the liquidity score is from 1 to 5, and 1 and 2 are extremely liquid. So there's a very, very high turnover. So if anybody out there says that bonds are not being traded, it's simply not true. The second thing you are definitely interested in, and you know this from the equity markets, is who are the people who are buying and selling our bonds on the secondary market. And I personally think this is something that people have not spent enough time on and have paid little attention to for whatever reason. But I think it is absolutely crucial to have the correct data to understand who your bondholders are, and these are the bondholders in the secondary market. And there are some sources available on publicly available data, for example, on Bloomberg, or if you have the fixed income module of BD Corporate, you can see some ownership, but it's only a very, very, very small part of what's really out there, and it's typically outdated. And why is that the case? Because, as I said earlier, it's a very intransparent market. There's very little obligation to disclose bond holdings, and hence you will see just a very little small portion. So what you need to do is you need to ask for a bondholder identification, and the holders in the secondary market can be identified. So typically for a euro or a dollar bond, we are able to identify 85%, 90% of the holders, because a lot of them are, of course, institutional holders. And that gives you a very precise overview, not only who the investors are and their contact details, but who the decision makers are. So who are the fund managers behind the decision of buying or selling or not buying your bond in the first place. So that is the fundament. Again, it's the same thing as for equity, for roadshow planning. So the basis of all your creditor relations work, and at the end of the day, investor relations work. So roadshow planning is key, and to have the right and accurate data and to know who the investors are. Secondly, very important and interesting to look at is the allocation list, which you should all have when you issue a bond, and compare that with the secondary market after a certain period of time. And then you can see who has sold out of the bond after issuing and being on the primary allocation list. And even more important is who is investing in the secondary market, at what price, and why did they not make it on the allocation list? Why were they not on the primary allocation list, which might have reduced the cost of refinancing already? So you see the buyers, the sellers, and of course the holders. And as we all know, the secondary market has a substantial influence on the interest rate of the next bond. That's what this whole exercise is all about. So to summarize, what did we look at today? The key benefits of creditor relations: it's access to international capital markets, it's the aim of lowering the interest rates, and of course it's very relevant to raise the company profile. Creditor relations is a key component of capital governance, and capital governance again being part of ESG or corporate governance. And it's extremely relevant for shareholders. We've seen it from BlackRock, we've seen it from Norges, we've seen it from all the big investors, that ESG is playing a big role, and capital governance is definitely one part of that. Secondly, the secondary markets are the key benchmark for your next bond. And here it's important to have as much information as possible. If you speak to just one bank, they see only a very small portion of the market, and it's important to look at the wider picture and get as much information as possible to have a representative figure for the secondary market. And again, as Marcus very interestingly pointed out, 1 basis point has a massive impact because it goes right down to your bottom line earnings. And thirdly, to know the investors, it's important to know about the price, to see the liquidity and who are the holders in the secondary market, as well as who are the buyers, and last but not least, who did not make it on the secondary or on the primary allocation list. With that, I would like to wrap it up and hand it over to Bülent to see if there are any questions. Please, if you have questions, put them into the chat, or we can open up the discussion now. Thank you very much.
Dear Patrick, dear Dr. Marcus, thank you for your valuable information. It's very great and a new window for our debt IR society and valuable information for our debt IR working group. If any questions, you can post on chat screen. So send them Patrick and Dr. Marcus, or write us later to send them. And we recorded this video and presentation video, and also we can share the presentation with you. Maybe after that you detailed see the presentation and video. You can also post the questions, send them IHS Markit and DebtBay. Any questions? I think not. Just a Here's one question from Emre Yılmaz. What is going to be happen in terms of risk premium increases in CDS of emerging markets, especially Turkey?
Thanks for the question. I think your question refers to the fact that the premium a company has to pay has also a strong link to the premium international markets are demanding by a country like Turkey. So if the CDS, for example, in Turkey goes up because of the COVID-19 crisis, for example, then this has a massive impact also on all other companies which are headquartered in the Turkey. So yes, this is a very important topic to mention, that you, and I think Turkey isn't really an emerging market anymore. It's a bit more, it's already more a developed market rather than an emerging market, but it's still, there is a high volatility in the CDS of the Turkish sovereign CDS, and this has a massive impact on your company. It is like how to deal with it from the company perspective. You cannot really do anything about it because it is like the basis which is more or less determined by the central bank. This is a political influence which you cannot do something about it. So you have to accept it, but it shows how important it is that you are covering your specific risk premium apart from the basis and apart from the influence of the sovereign CDS to your corporate CDS. It shows the importance that you are really after each and every basis point of your specific corporate CDS.
Thank you. Another question. Up to now, there's no question. As I said, after sharing the video and presentation, we may collect and gather the questions and send to you. So if you have any other comments.
Well, maybe I might ask, well, I have a question to the audience. Maybe you can give us a feedback in the chat that to which extent have you been aware of the creditor relation concept right now, and especially as I would say as a single discipline next to investor relations. I mean, it is very, very a close relative, but it's not completely the same. So maybe it would be great if you can give us in the chat a bit feedback on that question. Also by hearing this discussion.
Here we have another question.
Yes, what will be the effect?
There's one more. Just a second, please.
I read the question. What will be the effect of increases in the PS of American Central Bank, and also the same for European Central Banks and also Turkish? I think at first we have to make it this distinction. No matter if you are an issuer from Turkey or from Germany, the currency you are intending to issue a bond is always crucial. So let's make an example. If you are an issuer from Turkey and you're intending to issue a bond in euro, then it is not important what the Turkish central bank is doing, but it is very important what the ECB will do, for example, in terms of interest rates, etc., etc. So this influence will also meet you directly, even if you are headquartered outside of the Eurozone, to stay with that example. So you have, I think this is the first answer to the question. And the second thing is, there will remain, of course, some political risk, for example, which comes from specific situation in the Turkey or from the specific economic situation in the Turkey, which then will be covered in your corporate CDS. So to make an example, the basis is exactly the same than, for example, for Deutsche Telekom, but the political risk or the economic risk, which maybe is more or less than in the Eurozone, will be reflected in your company CDS. And therefore, it is very important if you go out to the investors and tell them the right story from your perspective. For example, to tell them, to start the discussion with them, what they have heard in the international media, for example, about the Turkey, and what is really true. Because once they know the arguments which coming from the country, which we're talking about directly, then they might change their opinion a little bit. And when I say they might change their opinion a little bit, it is very important, because a little bit means, for example, 1 or 2 basis points, and you can take out benefit for it. So to summarize this question, I think it is crucial, or the currency you are issuing a bond is crucial, because then the effects from the central bank, and the same is true for US dollar, of course, will have the same impact to you as the issuers which are headquartered in those countries. But apart on that, on your company CDS, the specific economic and sovereign risk from Turkey will be reflected, and it is a very good idea and a very good strategy to search for a direct communication to the main investors in order to bring down their concerns. And there is another question: what will be the effects in terms of inflation or devaluation of the local currencies? The first is, once you have issued a bond, for example, in euro or US dollar, then the effect on the bond will be zero, of course. But the effect on your balance sheet will be massive, because your cash flows, of course, are in local currency. And then you can have there a huge currency gap, which you really have to manage. And how can you manage it? There are at least 2 main strategies for managing this really huge challenge. The first is you make a perfect hedge. For example, you're entering in some currency swaps, reducing the currency risk during the duration of the bond to 0. Of course, such a swap has some costs, and you have to make sure from the beginning, and then I mean, once you plan to issue a bond, you have to be already aware of this very, very important question. Then you have to look for an appropriate cross-currency swap, and you have to make sure that you are aware of the costs such a hedging strategy applies, and then you have a great decision making base where you can decide on, for example, would you like to issue a Eurobond at a much lower rate, but you have to take into consideration that you have to add to the lower interest rate your hedging expenses, or option B, that you are intending to issue a bond in local currency, knowing that the interest rates are much higher, but then you don't have a currency risk. And there is a third strategy as well. It is called a proxy hedge, because it's not a real perfect hedge. And you can describe it if you are an international player, which is headquartered in Turkey, but you have sufficient cash flow, for example, in US dollar or euro, then it's a great point that you go to your controlling department, checking the numbers. And once you know that there is a substantial amount, for example, of dollar cash flow, then it is even a good idea, and it is called a natural hedge, that you issue a bond about the size of your cash flows, because then also from a balance sheet from the Turkey, you have almost a perfect hedge, making your financial results even more resilient than they would have been before. There is another question. What about steeping?
And one more question.
Yes. Then there's another question. What about steeping yield curves worldwide? How to handle in terms of creditor relations? I think, yes, this is a very important point, but the answer has to be high level, but it is quite important. Once you see that the yield curves are steepening worldwide, which we are facing right now, then the first and very simple answer is creditor relations have become much more of importance than they have before. And this is also the reason why we named our webinar Creditor Relation in Tough Times. Because once the world is okay, the so-called Goldilocks scenario, which we have faced, for example, during the last decade, a lot of years, then everybody says it is fine, the economy is running well, political risks all over the world are diminishing. So I don't really see an value added in talking directly to a company, because everybody's fine. Now it is the very opposite. The need for direct communication between investors and companies have increased dramatically. And I think the positive news is that everybody of us now is facing to a higher or a lower extent somewhat a crisis, some kind of crisis, but it is coming from external. So it is not, and this is a very important point, it is not the fault of your management, it is not the fault of a wrong strategy you might have applied for. No, this is not the reason. They want to know how you are covering with the challenges we are all facing. And once you have a good story to present, and once you're able to convince them that you are really the right strategies in place to cope with this worldwide crisis, then you have a very good chance that you are reducing the risk premium meaningful.
Thank you so much, dear Patrick, dear Dr. Marcus. We would like to run another webinar on more details on creditors' relations, if it's okay for you.
It would be a pleasure for
Yes,
us.
of course. Thanks.
And thanks a lot to all of us. It was quite a great webinar today. And I'm looking really forward to take it up from there in more detail, where we have the possibility to concentrate on some specific element of creditor relations or the debt capital market in more detail.
So see you on a new season, let's say September and the following months. Thank you for
Excellent.
your effort. And
Thank you very much. Thank you. Very much
Thank you
appreciated.
very much. Thanks and have a nice summer.
Bye-bye.
Goodbye.